about the ins and outs a bit more with Chris Ligoudis, co-founder of GNM based out of Sydney. Chris has put his applied finance masters to work over the last 20 years in the industry across most asset classes, working with the CBA research community for a number of years as PSK CIO and part of the Advice Exchange. She is now running and broadening out a fantastic firm at GNM, as many of you are aware. So Chris, with the panel, let's come to stage and you can tell us how easy it is being a CIO right now. Ladies and gentlemen, Chris Ligoudis. Thank you, mate. How are you?
It's good. It's only good because it's only easy because we're dealing with Grant Samuel. So
yeah, there you go.
Keep it simple.
Thanks very much.
Nice plug. Thanks for having me today. Obviously great presenters and great sessions from the three of you, and obviously the video today. I thought we'd start off with the first question being for Jeff. Some of these questions are a little bit controversial, but given private markets are topical here in Australia at the moment, and there is a bit of focus on the asset class in particular. So Jeff, where are private market investors going to get caught out over the next decade?
Great question. So I think where they're getting caught out now, the mess that we're seeing in private equity, this lack of monetization, I think it's really a result of the tailwind that allowed for financial engineering, which might be beta, it could be luck, but to the extent that debt was cheap, and you could realize a very decent return simply by selling something at a better multiple than you bought it at, and you could refinance the debt along the way, more of the cash flow accrued to the LPs. But if you're selling something at 10 times and buying something at 10 times and selling it at 12, fantastic return. But I think that that tailwind, that was falling interest rates, or lower cost of capital, rising multiples, I think that's likely less, behind us. And so I think kind of what they're going to get caught out in the future is, private credit is way too easy to say that you're doing it. It's very easy to raise money with a story. Putting the money to work is actually much more difficult. My first question when talking to private credit managers is what is your origination advantage? You can't just knock on the door of KKR and say, I've got a large checkbook. I understand you do take privates. Let me provide some financing. If you don't, I've had this conversation with Don Young a number of times at Canal Road. If they don't know who you are, if they don't know that you can turn around a decision quickly, that you know how to work with a private equity sponsor, you're not part of that network. So you're always supposed to be cautious when any asset class grows quickly, and I'd be careful about private credit over the next 5 to 10 years.
The easy money's been had. It's an easy way of saying that.
The easy money by everybody, has been had.
Cool. All right, thank you. I'm going to ask another question, so we'll leave Mark to deal with the microphone. So maybe, Emmerich, if you could give us a bit of a feel for how you navigate the fragmented regulatory framework in Europe, and is Russia, Ukraine, and other events like this already priced in?
Okay, I think that these are two questions, but I mean, the fragmented regulated framework is one that I'm happy to take. Indeed, Europe is a very, very fragmented market in terms of regulation. You have 30 countries. Arguably, you have 30 regulators for different sectors. I think it's not that different from the US, where you have 50 states and you pretty much have 50 different regulations. I think what is important is to understand what you're getting exposed to. And for that, you need to have, basically boots on the ground. This is not my response to Ukraine. It's really on regulation. And then what you need to do is diversify your portfolio across different subsectors that have basically different regulatory frameworks, but also diversify your portfolio with assets that are not necessarily regulated. Because by investing in some assets where you have typically long-term contracts with investment-grade counterparts, you avoid this regulatory risk, and that's a good recipe for proper portfolio management. Last word, maybe I could say on regulatory risk is that countries are competing one with each other in terms of ability to attract capital, ability to attract people, and on support to growth that infrastructure is providing. And therefore, this dimension, this competitive dimension, implies that you should not expect that many negative regulatory moves across infrastructure.
Sure. And just the last question, that was a two-part question. Russia, Ukraine, and other events like that, are they already priced into the assets that you're seeing and dealing with, or is there more risk to be priced in?
Well, I mean, obviously, few investors had anticipated that this would happen. Nevertheless, what we've seen is that most portfolios have not suffered from the war in Ukraine. It has created some new investment opportunities, and for instance, ourselves, we've benefited from that. We are holders of a portfolio of LNG ships. They were yielding very nicely. All of a sudden, their strategic value has increased quite drastically, and we recently sold them. I think what the war in Ukraine is doing is also raising awareness on a risk that we all have on strategic infrastructure assets, and it's related to the protection of these assets against terrorist aggressions.
Thank you. Back to you, Mark, given the microphone didn't like the question, obviously.
Yeah.
Asking the question again, to what extent is liquidity just an illusion in private markets?
Good. So now you can hear me. Good. Well, I think first and foremost, I mean, I think it's important, right, to understand that you can't. There's no alchemy here, right? So you can't create liquidity out of something that is not liquid, right? So it's all about portfolio construction. So, and I think that's extremely important if you consider liquidity and products that have gates and all that. It's extremely important to go beyond just the terms and to ask questions about how this is built and incorporated in the product, right? Because although very flexible liquidity options can be appealing as investors, as an investor in a fund, you need to also understand that all the other investors have the same optionality, and what is good for you when you need your money might not be good for you when they need their money, right? So I think it's very important to understand that the way the portfolios are constructed is extremely important. In general, in private markets, the most complicated and I think one of the most overlooked aspects of investing in private assets is how to efficiently make private and public assets coexist in a portfolio. It's much, much more complicated, and a lot of return, there's a lot of disappointment about returns people are invest from private markets because they're sold IRRs prospects, and that's not what they're getting. They're getting time-weighted rates of return. And the link between the two is all about portfolio construction, risk management, and liquidity management.
Maybe back to Americ, if you could. Obviously, you talked a little bit about different parts of the European market. So what thematics in European infrastructure that I can't access in the US? So what's unique about Europe that I'd want to go there as an investor that I maybe can't get access to in the US, or good enough access?
Well, I think both the US market and Europe markets are gigantic markets. So I don't think there's anything that you would find in one market that you would not find in the other market. But if you look at the US market, if I'm being a little bit schematic there, I mean, the US market, as far as infrastructure is concerned, is essentially an energy market on a telecommunications market. On the energy side, it's been heavily geared towards oil and gas type investments. If you look at the energy transition part of the US energy market, it is today going through fairly troubled times. So in Europe, you would find more diversification. You'd find a higher number of utility type investments around waste management, water distribution, electricity distribution, smart meters. You'd find also a number of investments in the transportation sector that you would not necessarily find in the US. In the US, utilities and transportation are typically largely funded by counties through bond emissions that are giving way to tax breaks for investors. So these subsectors are less present in the US market than in the European one.
And maybe have some defensive attributes attached them to in terms of the types of sectors you're referring to there. Not defense per se, but they're defensive in nature in terms of the sectors you're referring to.
I mean, these sectors I just mentioned around utilities are very defensive. I mean, they are typically monopolistic or quasi-monopolistic assets, and therefore you have these long-term revenues, and they are typically the assets that are capable of generating cash yield, and we are very interested in cash yield. It is a little bit less the case, for instance, in telecommunications, where you still have a lot of construction work needed around data centers, around fiber, and therefore these assets are a little bit less yielding.
Cool, thank you. Maybe back to you, Jeff. So what can we do to ensure that private markets allocation does the job it's meant to do? So, i.e. dampen vol and deliver a circa 10% return, and that isn't shaped like my global listed equity portfolio.
So I think that's the right approach. I think the right approach to get involved in the private markets is trying to build that better client outcome, as I spoke to earlier. Alec mentioned this afternoon about diversification, the one free lunch in the financial market. So I think if you approach private markets with that lens, returns might be accretive. I'm a little bit skeptical on returns going forward, or maybe the magnitude of private equity outperformance over the public markets. Starting valuations are better, but you just have to think, I think, as the private markets have matured over the last 25 years, more capital's come into them, maybe maybe the market's now more efficient. I still think they outperform. I think you will get paid for that illiquidity premium. I think there's a signal versus noise argument. Private markets versus public, the ability to plan for the long term as opposed to quarterly EPS. I think the magnitude. So yes, returns might be moderated, or outperformance might be moderated, but I think the degree of outperformance among managers within private equity probably persists. And I think that's actually something we're seeing going the opposite way in the public markets, as the big Mag 7 in particular makes up such a big composition of at least the S&P 500.
Yep. And is there areas of the market, you sort of talk, a few of your answers were more forward-looking and sort of looking into the future. Is there areas of the market where you think there's, in terms of private equity, private markets, where there's greater certainty around that sort of return risk profile right now, or is that sort of changing too frequently to make that sort of a statement right now?
I think it's, I put it in the latter camp. Things are changing dramatically and quickly. As I think about our portfolio construction, and I think, Emmerich, you made this point, like infrastructure tends to be the steady Eddie asset class in portfolios. Private credit tends to be the shorter duration asset class. Most of the underlying funds or risk exposures are 1-year floating rate loans. VC and private equity tend to be longer duration. So obviously risk can change more over a longer duration, so we'll see.
Okay, cool. Maybe back to you, Marc-Andre. Deal flow is obviously key to private market success. Does that mean it's going to get harder for smaller players to deliver in this space?
Well, I think so, with a caveat, right? So I think it still works like, Rolodexes are important in that space in the sense that if you know that you're the 30th that an investment banker calls with a deal, and it's probably because 29 others said no to it, so it might not be a good deal, right? So I think that still plays out. So the danger is for firms, it's like style drift in listed markets, or if you analyze hedge funds and all that, that's what you fear, right? So the problem and the danger and the challenge is firms that are very good in their niche become big, and in some cases become too big for their niches, so then they're tempted to start to go in the bigger leagues, and then they're small there, right? So I would think there's a market, and probably what happens is the large buyouts are probably going to be the bigger and bigger firms that we all know and we've talked about here today, right? But that still leaves plenty of room for small players from a global perspective, but that can be big because they chose to stay and stick to more targeted markets. And I think that's what we're going to start to see.
Emmerich, did you have anything to add to that, given you talked about small cap investing in a smaller company investing in Europe? Obviously, and you talked about boots on the ground in terms of being throughout Europe. Did you have anything to add to that in terms of the ability of, like the Rolodex is mentioned, in terms of is small better, is larger better? Sort of just add to some of your comments you made earlier in your presentation.
Yeah, I think when you look at smaller transactions, you typically find yourselves in less competitive situations, and that's where the importance of the network is key, and that's where the local players have an advantage. It's much harder for I mean, a global firm, to be efficient in small cap investments, you need to have a manager that is present locally. And you also benefit in that segment of the market from much lower entry prices because you're dealing with proper partnerships with the management of the companies, and very often in that segment of the market, the managers have a say on who they want to see buying the asset.
And I've got something to add to that, Chris, which is, one of the things we look for in manager search is capacity and GPs' honesty about their capacity. To the extent that the fundraising environment's been generous over the past, decade, if a manager can raise 8 to 10 million, but they're raising 4 because that works for their strategy, that's commendable.
Yeah, that's a great ad. Maybe a bit of speed dating at the end in terms of what keeps you up at night. What are you most worried about in terms of the things you're looking at the moment? Maybe a minute from each of you on what you're worried most about, and maybe that creates some opportunity as well. Maybe starting with you, Jeff.
Yeah. So this lack of monetization, Wall Street's incredibly innovative. We've got a tremendous growth in the secondaries market, and now continuation funds. So I love this asset so much, I don't want to sell it. Well, or you can't sell it. And so I just worry that we're pushing this, a liquidity issue down the road, and it does call into question some valuations. But I think maybe the market, as it can be, maybe we've gotten a little bit too cute.
Americ, maybe.
I think, I mean, I'd converge with this. I mean, the alignment of interest with GPs is something that is particularly important, and we've seen recently sometimes some drifts in that segment with the temptation to set up continuation vehicles for assets, because GPs, they want to increase their AUMs because they have either an IPO inside or M&A activity inside for the GP itself. And I'm monitoring this proper alignment of interest on the drive towards exits of assets when these are ready for exit is important, and that's something that's keep me up at night.
What keeps me up at night? I would say I'm not sure going forward that private markets as a whole will outperform listed markets. I think you have to be very careful about what you pick. I think there's been too many solutions, too many new funds happening in private credits, more specifically. So I think that some constructions are a bit shaky. So I think there's going to be accidents in that space. So again, the due diligence aspect is extremely important, right? So the path dependency that Jeff talked about, like the danger of investing in the first story that's shown to you that is interesting, I would caution against that, right? So it's extremely important to source, select managers efficiently in that space.
So liquidity, governance, alignment, and due diligence being the three things called out by the presenters today. Wrap it up there, Ben.
Brilliant. Ladies and gentlemen, thanks Chris Theodis and to the panel.
Thank you.